Most of you probably know who Schroders are, but for those that don't, we're a global independent asset manager. We run about $45 billion of funds in Australia across domestic and global equities, fixed income and multi-asset strategies. In terms of the multi-asset business itself, the fund that we're talking about today and the strategies that we run in Australia are designed and run by the 5-person multi-asset team that sits here in Sydney. And whilst we're supported by our global network, we build and manage strategies and are accountable for the outcomes of those strategies for our clients here in Australia. So we're based in Australia and we're designing strategies for Australian investors. In terms of our multi-asset credentials and track record, we've been running multi-asset in Australia for many years, and this real return strategy was something that we developed just prior to the financial crisis to enable us to move away from the SAA model, the strategic asset allocation model that most people use to run multi-asset portfolios. And today we manage about $9 billion in multi-asset strategies, of which the bulk of that, or close to $8 billion, are in the real return strategies, the listed version of which we'll talk about today. So that's the sort of quick background as to who we are. In terms of the core beliefs that we hold and what sits behind the real return strategy, there are 3 things that we think are really important as investors when we think about investing in this part of the market. Firstly, we believe that valuations drive asset classes in the same way that they do for individual stocks. Valuations matter, and you'll see that as we move through the presentation and into our market views as to how we reflect valuation views within the portfolio. Secondly, asset allocation needs to be broad and flexible. We need to look at a wide range of assets to construct portfolios from, and we need to be willing to not hold assets that we think are unattractive and to be able to hold a lot of something that we do think is attractive, not to be constrained by artificial asset allocation bounds, which most of the multi-asset industry is. And thirdly, when we think about risk, we think about risk in the same way that most real investors do. It's about losing money. It's not about volatility. In fact, for us, in many cases, volatility presents opportunity rather than risk per se. And in fact, risk really sits between volatility, the risk of losing money at one end and not making enough money at the other. So failing to meet your objectives by being too conservative. We need to balance those 2 things out. So what does the strategy look like? What have we been trying to achieve and what have we achieved over the past 8 years? Well, the strategy has 3 primary objectives. The first is it's a growth-oriented strategy. The objective is to return CPI plus 5% per annum over rolling 3-year periods. The second objective is to manage volatility. Now, we don't think volatility is risk, but we do think that the smoothness of returns that we deliver is important to our clients. And thirdly, we look to manage the incidence and magnitude of drawdowns. So many times in the market, preserving capital is the best outcome to put us in the position to then invest for growth again. So if we look at this chart, the grey line on the chart is our objective. That's CPI plus 5. The blue line is the return of the fund over that period. And as I said, the objective is to try and track that as closely as possible. There are periods, however, when the fund does track sideways. Often they're periods when we are looking to preserve capital. And we've highlighted 3 of those on the chart where equity markets, and in this case we've used the ASX as our equity sort of barometer, have fallen sharply because of various events that are happening in the world. That's when the objective of preserving capital comes into play for our fund and gives us a position to then reinvest when markets have become more attractively valued. So that's sort of the history of the fund as to the performance in the unlisted strategy. The listed strategy is looking to, in effect, take that same strategy into the exchange-traded managed fund structure or exchange-quoted managed fund structure. A little bit more on how we've done that. I won't go through this in a lot of detail, but really what we're showing here are those 3 periods of market drawdown and all the components within the portfolio that we're working to try and preserve capital. So it's a combination of our exposure to those equity markets, but also having diversifiers such as positions in currency, fixed income, duration, sometimes put options we have in the portfolio will come into play. So the preservation of capital is around the true diversification of the portfolio. And we'll see a bit more of that as we look at the current portfolio in a few minutes. How much do we use our asset allocation ranges and how wide can they be? Well, for each of the three buckets of assets we've shown here, we've also highlighted how much of a range we can use. So growth includes things like domestic and global equities and property securities. We can be anything from 0 to 75% within our mandate range, so it's very flexible. Diversifying includes things like high yield credit, hybrids, emerging market debt, again, very wide range. And then the defensive bucket, which includes investment grade credit, government bonds and cash, we can be anywhere from 0 to 100. And you can see the sort of ranges we have used over the past 8 years and where we sit today. And what you'll note is we have used a lot more in credit in the last 8 years to generate returns than we have in equity. It's not to say we will always do that, but at every point in time when we construct our portfolio, we look for the lowest risk way of achieving our return objective, and credit actually has provided a lot of those opportunities in the last 8 years. The next 8 years, it could well be equity, and we might move that range a lot more than you've seen today. So why bother with asset allocation? You know, a lot of us have grown up thinking about stock selection, picking managers, and fixing our asset allocation into a sort of a target portfolio outcome. What these two charts are trying to show are the difference between asset allocation and stock selection. And so if we take the first one on the left, 2006 to 2009, and the first little box and whiskers on the far left, that's saying that Australian equity managers over that period in time, active managers, gave you somewhere between 0 and -5 in terms of the best and worst performing. It's sort of the 90th percentile range of those managers. But even the worst performing Aussie equity manager did better than the best performing global equity manager. And the worst performing global equity manager did better than the best performing REIT manager. So sometimes actually the value in moving asset classes can overwhelm the value in picking stocks or picking managers within them. And that's largely what we're trying to do. We're trying to expose the portfolio to those asset classes that give the return. We also do have active stock selection within the portfolio, but that's how we see the combination of both asset allocation and stock selection being important to portfolio outcomes. So how do we see the world and how are we positioned at the moment? This is a chart you'll see from us on a regular basis. This one is as at the end of November, so it has some of the moves post-Trump within it. And we publish this, as I say, every month. The vertical axis are our expected returns over the next 3 years. So 3 years is our investment time horizon, and the dotted line across the page gives you a rough indication of just how much opportunity we see relative to our investment objective. And as I mentioned before, when we think about risk, we don't necessarily think about just volatility. And in this case, we've expressed risk as the probability of loss. What's the chance of actually losing money on an investment? And to pick a couple of numbers out from that chart, you can see Australian equities, on our view, are quite attractive. Expected return in the order of 8.5%, and a probability of loss of maybe 25%. So 1 in 4 sort of risk that we have a year where we lose money in Aussie equities. If we look at REITs though, Australian REITs, even after the correction we've seen, we see an expected return of pretty close to 0 over the next 3 years, and therefore a probability that you lose money as being 50-50. So, if we're making a decision between those two asset classes, this framework helps us assess the opportunity set. And then outside of equities, you can see in green, we've got a range of the defensive assets, fixed income, and you can see where bonds are. They don't look as bad as they looked a few months ago, but they're still not yet attractive on our valuation framework. And then some of those yellow assets, they're the diversifying assets, things like global high yield and emerging market debt in the middle there. So that framework is important for us because, as I mentioned up front, we're valuation driven. We're value investors, and we're using our valuation framework to make decisions as to where we expose the portfolio and how we're positioned. And so given the lack of assets above that hurdle, you can understand perhaps why our portfolio today, which is on the right, is quite defensively positioned. We have our traditional balance fund on the left, which is constrained by its asset allocation and has to have at least 60% of its portfolio in equities and growth type assets. We don't have those constraints with real return. So when we don't see opportunity to invest and we're not being paid to take risk, we will hold a defensive portfolio, and that is how we're positioned today. So, equity of around 30%, cash of around 30%, and then a range of sort of fixed income and credit investments throughout the portfolios. Hopefully that's given everyone an understanding of how we're investing in strategy.